Hello, I'm Brian Shaitkin, Senior Economist with the Conference Board, and welcome to the June Economics Watch, Halted Profits, a tale of inflation, wages, and earnings. Why are we expecting profits to be weaker in 2019 than 2018, and in fact to stall out in terms of profit growth? Some of the key questions we're going to be addressing on this webcast include: what is the role productivity, pricing power, and wages play in shaping profit growth? What factors are causing wages to grow at a rapid rate, but at the same time for inflationary pressure to still be quite weak? And can the profit outlook for companies improve during the next year? And what are the factors that would be needed for that improvement to take place? You can earn CP credits during the course of this webcast. You have to stay on for the entire webcast. Click OK as the pop-ups come up. And credits are only available for live participation. And in addition to that, I encourage you to ask questions. You can do so in the question pod on the webcast screen. And we always like to hear your questions. It provides us with a fantastic perspective about your feelings on these issues and what is important to you. So we will endeavor to answer those questions in the best way possible. So please ask them. Joining me to my right is my frequent partner, Gad Lebanon, Chief Economist North America here at the Conference Board. Gad, welcome to Economics Watch this month.
Thank you, Brian. And I just want to say two things to begin. First, I want to apologize for my voice today. I recuperating from a cold. And second, I want to let the audience know, those of you who have been following us, that unfortunately today is Brian's last webcast with the Conference Board. Brian is leaving the Conference Board, and I want to take this opportunity to thank him for a great webcast for many years. Thank you.
And thank you, Gad, for being such a fantastic partner. And thank you to all of you, because conversations, be it through Economics Watch, through council and conferences, have been a fantastic learning experience for me, and the opportunity to speak to all of you has been a true privilege. And with that, let's talk about what's happening in the US economy this month. So recent consumer and industrial data are confirming, and along with what's happening with the bond market right now, confirm that 2019, despite a strong start from a GDP perspective, is likely to see a growth slowdown during the course of the year. We do expect that growth is going to slow for the next 3 quarters to an average of around 2%, in line with the long-term trend we expect for the US economy. That weaker growth is in part explained by what's happening from a retail sales perspective, where you've seen stalled momentum. That's also happening in terms of personal consumption, consumer spending measures that are coming out. I would expect those numbers to improve during the course of the year, simply because the labor market is in a sufficiently strong position that the end result of that is that you're going to see that the labor market, that the fact that people are employed, they're earning quite a lot, or at least earning more than they were in the past, that is going to lead to some support in terms of consumer spending, and we'll explain why you're going to see that 2% growth stay in line. But businesses are definitely experiencing a loss of confidence to some extent. Capital equipment spending, a very important leading indicator, has weakened considerably since the middle of 2018. In addition to that, key measures of business confidence, as we'll discuss, have also been trending down. And that's also reflected in the bond market, where not only are weak inflation data playing a role in driving the 10-year Treasury down and driving the yield curve into inversion, where the long-term 10-year Treasury rate is lower than the Fed funds rate, but in addition to that are concerns about future growth. Not necessarily that recession risks are rising, but that investment activity has indeed slowed. And the combination of a tight labor market where unemployment is at a 50-year low, but at the same time, and that's creating rising labor costs, but at the same time, lower inflation, that is going to be a drag on profits, because when firms' costs are rising, but their ability to pass on those costs to consumers is not, that results in a shrinking of margins. So the question we'll answer in the second half of our webcast is whether the possible strengthening of productivity growth can help businesses overcome those price and wage growth dynamics that will result in diminished profits. Moving on to looking at GDP in more detail, you can see that in the first quarter of 2019, that gray area, which represents net exports, and the purple portion of the bar, which represents inventories, those contributed quite a lot to GDP growth. What that means is that the GDP growth in the first quarter is not necessarily sustainable, because firms cannot endlessly build inventories. In fact, rising inventories are a signal to cut production to some extent, and so you're likely to see firms do that. In addition, in terms of trade, it is true that some of the trade tensions with China may end up causing a longer-term weakening from an imports perspective, or at least stalled growth. But it's unlikely that imports will continue to decline in the way that they did during the first quarter. So what we expect going forward is for growth to be 1.8 in the second quarter, 1.8% in the second quarter, and then around 2% through the end of the year, with strong growth in terms of consumption, the blue part of the bar, but less growth from an investment perspective. I think that difference between what's happening from a consumer and business perspective is a very important thing for businesses to watch right now. So Gad, the labor market right now is featuring the lowest unemployment rate since the 1960s, but employment growth is slowing. Do you expect that to continue, and what does that mean for the tightness of the labor market going forward?
Yeah, thanks, Brian. So in the latest jobs report, employment was disappointing, growing at about 75,000 jobs in May. So it's probably 75 is not the trend. The trend is much higher, but it is probably lower than it used to be in 2018. So I think we are seeing a slowdown in job growth. Part of it is a result of the slowdown in the economy, but part of it could also be that it's just harder to fill positions. We know that the recruiting difficulty surveys are suggesting historically high difficulties, and also the time to fill position is growing. So that's probably also holding back employment growth as well. So I think moving forward, that's likely to be the situation of a slower employment growth, rather than 200,000 a month, probably more like 150. But even 150 in a period where the working age population in the US is barely growing at all, is likely to continue to tighten the labor market. So I think we will see even more tightness in the coming year, and as a result, the acceleration in wages is likely to continue.
So we talk about acceleration in wages. Over the last few months, wages have continued to grow at a faster pace than they were earlier in this cycle, but have stopped accelerating. Why should we expect this acceleration to resume?
Well, you know, in economics, with noise in the data, nothing goes in a linear line upward. There are already some fluctuations, but you know, if the main determinants of wages are labor market tightness, inflation, and labor productivity, So at least labor market tightness is likely to continue and even become tighter. Labor productivity, as we'll talk a little later, is showing signs of acceleration. Inflation is not accelerating, but 2 out of 3 suggests to me that we should expect more acceleration in wages.
So one other factor that may be playing a role in thinking about how employment growth and wage growth may evolve is the loss of business confidence. And what this chart shows is a real divergence in recent months between consumers who still have high expectations for where the economy is going, and that's what's shown in the blue line, versus businesses who are shown in the ISM Manufacturing Composite Index, who have clearly lost confidence in the direction of the economy. What accounts for this divergence?
Yeah, I think that 2 things. I think consumers, or certainly the way the consumer confidence is measured in our survey, is extremely dependent on the labor market. And as we said before, while there may be a slowing in the last couple of months, but in general, job growth is solid and wage growth is solid. So there is no reason for the consumer to feel much less confident. Whereas businesses, they are looking at things like the prospects of the US-China trade conflict and and also what's happening in the rest of the world, where there are some growing concerns there. So they may be more concerned. But I should say also that the red line here, the line that is representing the business confidence, is just for manufacturing. Manufacturing is certainly weaker than the rest of the economy, partly because of the weakness in the rest of the world. So I think business confidence is not as, or if you looked at the other ISM measure, it's probably not as low as it is for manufacturing.
And that's an excellent point, Gad, because this dynamic between this difference in terms of where the manufacturing sector is headed and where non-manufacturing services are headed is something that's really important to think about from a growth perspective, from a profitability perspective. We're seeing it from an employment perspective where manufacturing jobs have not seen nearly the same. In fact, they've basically plateaued during this year, so they haven't seen nearly the level of growth that you've seen over the last 2 years. And some of that is a question of trade tensions, where the ongoing trade dispute with China and the increased and broadening of tariff measures, that's certainly hurting manufacturers most in terms of managing their supply chains. And I think also what's happened recently from the perspective of threats of new tariff impositions with regard to Mexico, I think that also gave manufacturers pause because it shows the possible broadening in application of tariff measures to issues that do not directly impact upon trade. And even though those threats have been withdrawn, that's definitely something that is affecting planning in the manufacturing industry, less so than in non-manufacturing, where obviously the service sector is still affected by how trade is being conducted, simply because you have a situation where the relative performance of the economy will play a role in shaping manufacturing demand, but it's not quite as reactive to shifts in trade as would be the case with manufacturing. Now, an upside in terms of the current economic outlook right now is this possibility that the Federal Reserve may cut its policy interest rates. We're right now forecasting that that will take place in December. Many forecasters are suggesting that may occur as early as the next Fed meeting in June. Gad, what are we learning about what's happening right now in terms of inflation trends, and how might that shape the Fed's decision? And do you expect these trends to continue?
So let me turn this whole question over to you, Brian, because in our last couple of years, between the two of us, we had an ongoing debate. I was expecting inflation to appear. You were not. So you're more correct than I am, so you probably have a better answer to that. So let me ask you, Brian, why isn't inflation picking up?
Okay, so there are a few structural factors that I need to start with.
Well, it's the last webcast, so take your time.
Okay, so first of all, from an e-commerce perspective, simply the fact that price comparison has become much, much easier in the last decade or two. That's a factor that restrains firms from raising prices. And I think it's important to recognize that this is not a 1 year or 2 year situation. This is a 20 or 30-year situation. The U.S. really hasn't had particularly damaging episodes of higher inflation for now several decades. So you really have to look at what are the structural dynamics that may be causing that. I think another important structural dynamic is the combination of globalization and improved supply chain logistics. Part of that is increased global trade and the ability to source components from cheaper sources. But another part of that is just digital technology, improved coordination, the ability of companies to, on demand, ensure that they have those components when and where they need them, and that prevents a certain level of overbuying, and that reduces demand. Slower population growth, Gad's favorite explanation, which means that you have less overall demand, less need for companies to expand production, and that's certainly a factor that holds down prices. And then finally, I think it's important to recognize that the reduction in competition in many sectors, and the fact that that reduction in competition has been often led by a small number of incredibly productive and innovative firms that have managed to lower costs across many, many types of industries. That is a key factor, because what that means is that the markup over marginal costs, firm profit margins for each individual unit, those have actually gone up, but those have gone up in part because companies have become more productive, and therefore when wages are increased because of a tight labor market, there's less of a need to pass those costs on to consumers for those larger firms, simply because their profit margins are relatively healthy to begin with. So that, I think, is a key factor. So all of those factors explain why there is less inflation, in my view, on a structural basis. And I think the Federal Reserve right now is struggling with the fact that normally the types of labor market dynamics that Gad is describing would generate higher prices. But right now they aren't. Now, will they in the future? Should the Federal Reserve be more mindful of tight labor market conditions? We'll see over the next few months.
Yeah, no, I think those are all good reasons. In general, I have some skepticism about this time is different arguments. So, I'm more of a basic theory kind of person. If wages are growing faster, I think at some point it should be reflected in prices, but I have to admit, so far it hasn't. Whether or not it will happen in the future, that's a good question.
It's a question you'll have to tune in for future episodes of Economics Watch. Let's turn to investment, Gad, because this chart shows two very interesting trends. Number one, you see a general slowdown, not just in our forecast, but in actual data through the first quarter in investment activity, and this extends across all three categories: equipment, structures, and also intellectual property products, which are mostly made up of research and development and software spending. So you're seeing that slowdown since the middle of 2018, and then you're also seeing that intellectual property products have grown at a faster rate and we anticipate will continue to grow at a faster rate than other investment categories. Gad, what do you see as the cause for those trends?
You know, it's hard to come up with an explanation of why there is a pickup in intellectual property products and not in equipment, for example. It could be that, you know, a lot of companies have a lot of cash now, but they don't have an immediate need to increase production. So they spend it on things like research and development as opposed to equipment. That could be one explanation.
I think another explanation is simply that the economy has shifted away from hard assets and hard investments to more intangible type investments. Last year, we had the pleasure of welcoming on Jonathan Haskell and Stian Westlake, who wrote an excellent book that I would highly recommend you checking out. You can check out that webcast in our archives. And yeah, I would highly recommend checking out that argument as well, because I mean, that explains sort of this shift towards more investments in software and research and development. And also I would add in things that aren't necessarily captured in investment. So spending on cloud computing, spending on employee training. So there are definitely categories of investment that maintain fast growth. Spending on warehouses, not surprising. Warehouse construction, not surprisingly, is growing at quite a high clip. But other areas are seeing slower growth. And in addition to that, structures, a large portion of that is oil rigs. We have seen a decline in oil prices, so that may be playing a role as well, a lack of investment in petroleum exploration. In addition to that, the last month or so of stock market behavior has been dramatic and illustrates a few of the trends that we're talking about right now. So you can see in the red line that after reaching record highs about a month ago, the stock market took quite a tumble, but has since recovered most of that lost ground. Some of that was as a result of shifts in trade policy and fears around that. But also, I think it's important to mention that as rate cuts have become more likely, the end result of that is that that leaves companies more optimistic about the future of economic growth going forward. And so that's a factor that may be driving growth in a more positive direction, may end up providing some support to the stock market in anticipation of that rate cut. Now, what's important to mention here is that many businesses, many traders are now anticipating as many as 2 or even 3 rate cuts during the rest of the year. If those rate cuts do not materialize, even if our scenario comes true and there's 1 rate cut later in the year, that may result in a further deterioration in business confidence unless there is evidence that growth has picked up or that firm pricing power has picked up, because that's a big factor explaining why we're anticipating profits growth to slow.
Brian, if you stay on this chart for a second, I think another very important trend that you mentioned before is that since November, we had more than a 1 percentage point drop in the 10-year interest rate. That's a huge boost to the economy, a huge boost to the stock market, because it reduces the willingness to invest in bonds when rates are so low, so people go to stocks. I think that's a great support for the stock market nowadays, and probably for the economy as well, especially in industries that are sensitive to interest rates like housing and automobiles and such.
And speaking of housing, I think housing right now is an important sector to be mindful of. So this table here presents our overall forecast. So first, I just want to talk about the headline GDP number, which shows weak 1.8% growth in the second quarter, about 2% for the rest of the year. And then in addition to that, residential investment, which has been one of the weaker parts of the economy, we do anticipate through the end of 2020 that is going to experience an improvement. And there are a couple of reasons for that. First of all, housing prices are not growing quite as quickly as they were before. So there is a sense that the market, from a supply and demand perspective, is coming into a more rational place. So that may help in terms of home purchasing and increased demand and increased investment. In addition to that, the lower interest rates that Gad spoke about, that is resulting in many, many mortgage refinancings, and also will help in terms of encouraging people to purchase homes simply because they'll be starting from a place of lower interest rates. And then finally, the tax law that was implemented at the beginning of last year, that changed how the mortgage interest deduction functioned. It made it much less useful both for lower priced and higher priced homes. And so the end result of that is that it took some time for markets to adjust to the fact that prices needed to be a bit lower to compensate people for less favorable tax treatment from a home ownership perspective. So all of those factors are playing a role in, will play a role in supporting, I think, a modest recovery in terms of residential investment. So that's definitely something to watch. Gad, what other trends should members be aware of as they make business plans for the second half of this year and going forward?
I think it's always good to pay attention to what the consumer does. We at the moment, we keep it pretty flat at a nice trend of above 2.5%. So it will be something to pay attention to if we're seeing any signs of weakness in consumption.
And we have another question here about non-residential construction in the public sector. And it is hard, and the fact that those numbers have surged, and it is extraordinarily hard to figure out exactly when new spending will end up showing up in GDP figures. One thing I should mention is that we are anticipating that over the next few quarters, government spending is going to make an increased contribution to GDP. And part of the reason for that is the approval of the Bipartisan Budget Act, which increased federal spending levels. However, it's taken more time than we had initially anticipated for that spending to start showing up in GDP. And so it's very, very hard to anticipate exactly how those trends are going to play out. I will say, though, that states and local governments are right now collecting more tax revenue than they did in the past. And so you would expect for there to be relatively more public spending now than during a period of budget cuts. But on the other hand, many of those public construction projects have a very long lag time and are subject to some factors that are just very difficult to forecast. So that's my general perspective on this question of public non-residential construction. And I think it is important for many firms out there to keep track of not just federal infrastructure projects as they may or may not evolve, but also state level infrastructure projects and spending. Now, in the second half of the webcast, we want to talk about a phenomenon near and dear to the hearts of nearly everyone on this webcast: profits. And the question of, given that 2017 and 2018 were strong years for profits, what is going to happen in 2019. So first we have a poll question to ask you what you think the main drivers of profitability are going to be over the next year. Are they going to be for your firm? Are they going to be higher wages, weak pricing power, a likely slowdown in economic growth, the inverted yield curve, trade tensions, or difficulty making investments in new technology pay off? So we'll take just a moment to see what kinds of responses you have in mind and what you think are the most troublesome factors here. Okay, let's close the poll. Gad, the majority of our members are citing not price and wage dynamics, but a likely slowdown in economic growth. Are you surprised by those results, and what do you think of that analysis?
I think probably revenue growth is the number one determinant of profits in most companies, so I'm not entirely surprised. I guess there is a lot of concerns among our members about future economic growth, so perhaps more than we are. Yeah, that's. I think that's the message here, that companies are concerned about slowdown in economic growth.
No, absolutely. And I mean, as we'll discuss, that is one of many drivers, I think, of profits. I mean, how much you're bringing in terms of revenues, what are your unit sales? That is going to be the number one driver. And so that slowdown in GDP towards its 2% trend, that means across the board, companies in general are selling less. So just based on that baseline, you would expect profits to be lower. But there are some other factors as well. We've already discussed a relationship between tightening labor markets, which are leading to increased payroll costs, weak inflation growth, which is putting downward pressure on margins. I think it's important to remember that it's not just consumer prices that matter. It's also prices of intermediate goods, because guess what? Many companies are selling those goods, are selling machinery and equipment, and price trends in those categories matter more in terms of profits to those firms than would the prices of consumer goods. So that's something that we'll talk about a bit later. Trade tensions with China could not only reduce foreign market access, but they can increase domestic production costs for U.S. firms simply because it puts upward pressure on those prices for intermediate inputs, and also causes inconvenience and uncertainty, which may result in reductions from an investment perspective. For financial firms, they're in an especially difficult situation right now, simply because the financial industry is in the business of borrowing in short-term rates and then lending in long-term rates. So when long-term rates are relatively low, or in this case are lower than short-term rates, that erodes financial sector profits. The tax law created a one-time boost in after-tax profits, but going forward, that boost is not going to be there, and it's going to depend on economic conditions as they are influenced by the tax law, as they are not influenced by the tax law. They're going to shape future profitability. Now, it's possible that despite these wage, price, and slowing growth dynamics that are causing us right now to forecast no further profit growth through 2020, that profitability may still remain robust if productivity can pick up. And indeed, we've seen an improvement in productivity data over the past year. But as you well know, it is very, very difficult for firms to deploy new technologies in an effective way, and for technologies like artificial intelligence to spread broadly across many industries. So that is a tremendous challenge that many firms face. And so, simply boosting productivity is both hard. It is necessary if future profit growth is to continue, but it is going to be a very difficult road for firms to continue earning high profits in this environment. So Gad, you could see that profit growth peaked near the end of last year and has since been declining, both in terms of the after-tax measure from for all firms, which is presented in the blue line, and also a measure from the S&P showing total operating earnings of constituent members of the S&P. So what explains these recent trends in profitability, and what do you expect to happen to both of these measures going forward?
You know, I think, as you mentioned earlier, everything is working against corporate profit in 2019. Revenues are likely to grow more slowly than 2018. Most of the pickup in 2017 and 2018 that we're seeing in the profits here is a result of a surprise pickup in revenue growth, as partly impacted by the overall stronger economic growth in the US. In 2019, as we talked about, we think that this is going to slow down. It's already slowing down. At the same time, labor markets are tight and probably getting tighter. So the combination of that is squeezing the bottom line. Slower revenue growth, faster cost growth. That's the story.
Absolutely, and I mean that's an excellent point, that everything is working against profit growth, and that is extending to all sectors of corporate profits. So this chart presents financial profits, which you can see have been stagnant the last few years, profits earned abroad, which have also stagnated, and non-financial profits as well, which were growing quite healthily recently until the last few quarters. We've already talked about some of the factors that explain the trends in non-financial profits. What's happening from a financial perspective and the rest of the world perspective?
I think the financial perspective, you already mentioned the fact that a lot of financial institutions, they borrow short and lend long in terms of time horizon, and the narrowing or even the inversion of the interest rate curve, the yield curve, is squeezing the profits of financial institutions. The rest of the world, the slowdown that we're seeing in the US is even stronger in the rest of the world. The first quarter was a pretty big disappointment. Several big emerging countries saw negative growth rate, also Korea. And so we are probably the weakness in the rest of the world and impacting sales and profits from the rest of the world.
Absolutely. So that slowing in economic growth, I think the increased trade tensions are also a concern where companies are trying to figure out what is the future trade environment going to look at, like how much exposure might a company have to future trade tensions. That's definitely playing a role. From a financial perspective, I would add to the interest rate dynamics the fact that if you look at this chart, financial profits have been growing at a relatively weak pace throughout this cycle. Some of that's as a result of changes in regulation that occurred in reaction to the financial crisis, which generally create maybe a more stable financial sector, but at the same time perhaps a less profitable one as well. So that's a key consideration to think about. Now, we mentioned that if companies manage to figure out ways of using their labor and capital resources more efficiently, there's the possibility that despite these price, wage, and growth dynamics, they can indeed increase profitability. We show here two measures. First of all, real profits growth, which you can see, real non-financial profits growth, which you can see in the red line. I'm sorry, in the blue line. But also in the red line is this measure of total factor productivity. Gad, what is total factor productivity?
Total factor productivity is essentially the efficiency in which companies are using their workers and their equipment. So the more efficient you are, the more you have at the bottom line. So it's a very important measure or determinant of corporate profitability. Now, one of the reasons we show this chart is we want to take you back, or actually let's go to the previous chart here and look at the red line, which is also the majority of corporate profits is the non-financial domestic industries. You see the red line in the late 1990s, starting in 1997 essentially, is declining. And if those of you who are old enough to remember, the late 90s was a period of very strong economic growth. And not just that, as we can see in the next chart, if you look at the red line here, the total factor productivity, it was also a period of strong productivity growth. So despite those two factors, strong revenues and strong productivity, we had falling profits. And the reason is that the late 90s, early 2000 was the period with the tightest labor market in, I would say, the post-1960s era, and simply labor cost was growing faster than revenues. And in such an environment, corporate profits are falling. I think if the current period is not comparable, but in a way that actually makes it worse. We don't have the strong growth that we had in the 1990s. We may have some recovery in productivity, but probably not back to the late 1990s, early 2000. And the labor market is almost as tight. So that is, I think, a concern for corporate profits going forward.
Absolutely. And those are, I think, thinking about this present period is really, thinking about that 1990s period is very, very important in thinking about what the present profit environment looks like. Because in the 1990s, you had two things that were working for profits that aren't present now. Number one is that stronger overall growth. And that was driven by a clear set of technological adoptions that were definitely 100% playing out in businesses across the country. So adopting internet technology, having employees use personal computers more frequently. I think right now, and Gad will talk more about this as some forthcoming labor market research is released from the Conference Board. It's less clear exactly the extent to which new technologies are actually driving company productivity and are causing companies to be able to automate certain workplace functions. So I think there's a lot more doubt about the role that many technologies that have tremendous potential to boost firm productivity are actually playing in improving current economic conditions. And even with those technology and growth factors in place, the combination of controlled price growth and rising wage growth resulted in a period of weak to negative profits growth in otherwise healthy economic conditions, and indeed played a contributing role to causing the next recession. So I think that's a very important thing to keep in mind. Now, what we've done is built a model of profits growth to try to decompose profit growth into three components. First of all, is the price-wage margin. So thinking about those price and wage dynamics and how they're contributing to overall profits growth. Second is market size or scale of production. How much labor and capital are companies using? And I think there's a real doubt right now, given how much employment growth there's been and how tight labor markets are, whether companies are going to be able to sustain that employment growth going forward. And we think employment will continue to grow, but perhaps at a slower rate going forward. And so the one factor that can sustainably drive profitability is total factor productivity, is finding a way to make more out of a given set of labor and capital resources. And so what this next chart shows is the role that those three components play in terms of shaping profit growth. And these are annual figures. And you can see that over the last few years, that blue area, the price-wage margin, as labor markets have tightened without increased inflation, the end result of that is that that price and wage dynamic is dragging profits. But over the last 2 years, stronger productivity growth, stronger total factor productivity growth, gains that companies have made in terms of using labor and capital resources more efficiently. That is helping to boost profitability. But the question is going to be, as those price and wage dynamics continue to deteriorate from a firm perspective, what is that going to mean going forward in terms of how companies, in terms of what kinds of profits companies are going to be in a position to earn? And this chart here shows that in terms of how companies are thinking about those price dynamics, it's not just overall prices. It specifically can be prices on not just consumer goods, but also those intermediate inputs. So what this chart shows is that the GDP deflator, which is used as a measure of all components that go into GDP, what prices are across the entire economy. So in consumer spending, government spending, exports, imports, and investment as well. What are prices like? But businesses, in terms of non-financial corporate gross value added, so not just what companies are producing, but what they're adding at every stage of production. So this accounts for intermediate goods and things like that. Prices for those, as you can see in the blue line, have grown at a much slower rate than price growth, even for the overall economy, which again has been quite slow by historical standards over the last few years. And so because that those intermediate good prices are growing so slowly, that's another factor that's constraining firm profit growth. So that's something that's key to consider. Now, this chart shows what's happening in the yield spread, the difference between the 10-year Treasury and the Fed funds rate. Now, normally this measure would be positive. Right now, it is negative in part because markets are expecting that the Federal Reserve is going to cut interest rates, that believes that it believes that inflation is too low, and it may, as a result, reverse some of the interest rate cuts that made last year. And then in addition to that, that concerns about slowing growth are increasing, such that there's an increased expectation of these rate cuts. And so, as we've mentioned already, this is going to play a big role in shaping financial firm profits. And if those rate cuts are delayed, or if inflation growth does pick up without rate cuts occurring, that is going to have a major impact on financial firms, and not just financial firms, but also non-financial firms, which would then face somewhat higher interest rates than otherwise might be the case. So watching how this yield curve inversion plays out is going to be critical. But Gad, do you think what we could see in this chart is that normally a yield curve inversion presages a recession, and that there's a pretty good record of that occurring with a 1 or 2 year time lag? Do you expect that this time is different, or do you think that our members should be more worried about what's happening from the yield curve perspective?
Well, let's look at the 1995 year. We had an inversion and then 6 more years of an expansion. So I think the reliability of this indicator is questionable and is probably losing some of its value over time, especially when in a period where the natural rate of interest rate is much lower than it used to be, which is probably deserves a separate webcast in one of the most important trends in global macroeconomy in the world, decline in the average or the natural rate of long-term interest rates. So I think this is it's an important leading indicator, but I would not jump to conclusions just based on that alone.
Agreed. I think normally when the yield spread is inverting, that's a signal that the Federal Reserve thinks that there's a recession ahead. In this case, its motivations for possibly cutting rate cuts relate to inflation, which doesn't necessarily mean there is that danger of a recession ahead. So I think that's an important factor. Finally, in thinking about profitability, you've seen in the last year or so that blue line, which shows the 4-quarter change in labor productivity, that has increased in terms of its growth. And that's not in line with what we've seen in terms of productivity trends in recent years, where you can see in the red line that the 24-quarter average has been growing at quite a slow pace. Gad, do you expect this productivity growth to continue? And if so, what potential effect could that have on firm profitability?
Yeah, so you see, if you look at the blue line in recent years, there were several periods where it kind of improved just to disappoint again. So we don't want to celebrate too early that we're finally seeing a recovery in labor productivity. But I do think that there are more reasons to be optimistic now than a few years ago, partly because a few years ago labor markets were weak, labor cost was low, there were less incentives to replace workers with technology. Now when it's harder to recruit and labor cost is going up faster, there is more incentive to do that. Plus, we also did some further analysis and we have reasons to believe the impact on employment growth that we are seeing in recent years, the types of jobs that are slowing down are the types of jobs where automation is more likely to happen. So that makes us believe more that there may be a turning point in automation and that we're seeing more activity in the last couple of years. So I think it's more likely to be a sustainable trend, perhaps not at 2.5% like we're seeing here in the most recent 4 quarters, but I would say definitely more than 1% that we've been in this entire expansion.
And that's absolutely critical in terms of thinking about profitability, because what happens from a labor productivity perspective is going to play not an entirely determinative role, but definitely a critical role in shaping productivity trends. What is shown in this chart is different ways in which our 2% long-term GDP forecast can happen, and how those results from a wage, price, and working hours, so let's call it employment perspective, will shape profitability. So in all four of these scenarios, GVA, gross value added, will grow by 2% in 2019. However, in those first two scenarios, we're anticipating fast wage growth of around 3%, very slow price growth. And keep in mind that these prices are those non-financial GVA prices. So they're slower in terms of how they have been growing than overall CPI, which is growing at around 2% this morning. And even if you take the personal consumption deflator, that measure is growing by around 1.6%. So if wage growth remains fast, price growth remains slow, then different outcomes in labor productivity can shape how much profits decline. So if employment grows faster and labor productivity grows slower, as is the case in the first scenario, that means that profitability would decline by 5.6% during this year. If there's more productivity growth and less employment growth, then profits would still decline, but by much less, by 1.1% during the next year. Now, in the event that the wage and price dynamics are somewhat more favorable to business, that you have slower wage growth and faster price growth, that's where you get into those last two scenarios. And there, slow productivity growth and faster employment growth means a good year in terms of profits, 4.8%. If hypothetically everything we've said on this webcast is wrong, and the end result is that wages increase quite slowly this year, inflation measures pick up and firms gain pricing power, and then, as I think is much more plausible, productivity has a particularly strong year, then you could see profit growth that would match what we saw in 2018. So it shows that if there is a year where those wage and price dynamics surprise on the upside for firms, the profit environment can shift very, very quickly. The question is, which of these scenarios, Gad, do you think is more likely in this present tight labor market environment?
I think more the ones that, unfortunately, the ones that are more negative I think are more likely. I think 3% is very reasonable for wages, given that they're already growing past that rate. And the fact that we are constrained in this scenario, but also I think in reality, by a 2% growth in revenues, I think it will be difficult to, especially in a period of slowing economic growth, for productivity to save us in this case in terms of profits.
Absolutely. I mean, I think I would definitely keep an eye on that scenario number two, because as you mentioned, there is evidence that productivity growth will be better than it's been in recent years. It's not going to be spectacular. It's not going to be at the 1990s level, but it's going to be better. But at the same time, tight labor market, recent trends in inflation, which suggest that companies are not managing to pass those costs on to firms. And that is going to create an environment where we would expect profits to be stagnant to modestly declining. And so I think that's going to be an important thing, thinking about how our business is going to behave in this environment, and why is business confidence and investment maybe slower than we've seen in recent years. So that brings me to the top of the hour. Please take a look at our content as part of the Economics Watch program. You'll be able to see not only further Economics Watch webcasts, but also our Economics View publications, and also an overview of some of our key leading indicators and the Consumer Confidence Index. Next month, Please come back and continue your strong support of Economics Watch. Bart will be hosting GAD and also our senior economist in Europe, Ilaria Maselli, and our senior economist for emerging markets, Abdul Ehrenbaum, and they will be joining for a webcast on the global economic outlook, asking the question of should we worry about an economic growth slowdown, and thinking about how the environment is shifting as the growth and trade risks begin to evolve.
And looking at those pictures, a picture that I don't see there is of you, Brian, and for those of you who missed the beginning of this webcast, Brian is leaving the conference board tomorrow, so today was his last webcast. So again, Brian, thank you for so many webcasts and great job.
So thank you, Gad, and please provide your feedback on Economics Watch so that Gad and company can continue to improve this product going forward. So for Gad Lebanon, I'm Brian Shaitkin, and thank you for watching this month's episode of Economics Watch.